Hey guys, what's up? Welcome to another episode with me, Shashank Godappa. I am a SEBI registered research analyst, and here is my number. And today I am going to talk about my son's portfolio because a big update has happened again in that entire thing, right? So I don't know how many of you all remember this, but back 1 year ago, I actually made a video where I showed you that I have started investing in my son's portfolio the day he was born. So my son was born in May 1st, 2024. Today he is now 2 years old, and at that point I had started investing some amount, and the goal was to give this money to him when he turns 30, not before that, only when he turns 30. Hopefully he's married by then, and at that point I want to give him this entire corpus. So I've started using the power of compounding and to keep it long term. Now initially, as you can see, I'm just sharing this screen. As you can see here, 1 year ago I had made this video where I had invested directly into stocks, and I had approximately 10 stocks in that basket, and I'd invested approximately 10 lakhs in that basket. And then obviously the March fall happened, and then everything fell down. All of that was fine. But what happened is last year I got my SEBI license, and because of my SEBI license, there was a lot of problem in me holding individual stocks. Because if I do a recommendation on individual stocks in the public, I have my small cases, I have my swing trading group. So when I give them a recommendation there, I cannot hold those stocks 30 days before. I cannot sell them 30 days, 5 days later. So there was a lot of rules and regulations. So I said to make it easier, if any of the goal was compounding. So to make it easier, I sold all the holdings that was there. Not recently I sold them. Once everything came back up, I took everything out, and then I invested them into a mutual fund structure. Right now, obviously, I didn't invest in one mutual fund. I invested in multiple different mutual funds. And today, what I'm going to do is I'm going to show you the strategy that I've used. I'm going to show you how this portfolio has now what amount it has reached. Obviously, it has not grown from a XIRR standpoint because the market has been absolutely flat. But what I did was I started doing a lot of SIP during the lower ends of the spectrum, right? So I started investing a lot. So let me show you this entire strategy as well. Now, for other people who are looking for long-term mutual fund investing, I have also launched a 10-year fundamental mutual fund basket on small case. So you can go check it out. It's very affordable. I think it is only 5,000 rupees a year. And you can use a code called SAVE20 and you can save another 20% of that. This basically is, we have 9 mutual funds here, and this is only for long term. It is equity based mutual funds, right? Chalo, let's quickly go into the plan and I will show you how this has grown. So today it is May 2026. My son has become 2 years old and he has no idea that I'm building this corpus for him. Hopefully in the future, once he watches this video, he will know that. The horizon is 28 years left. Obviously 2 years are over, but 28 years are left. And the goal is 2054. At the age of 2054, I will give this entire basket to him, right? Now, what I have started doing is, I'll tell you some simple math. As of today, the basket is currently at 16,41,931 rupees, which I have been building over a period of time. Now, this includes two types of revenue. One is what I do, which is SIP that I do for him every single month. And the second one is whenever his birthday happens, whenever some event happens, people give him some cash gifts, right? So all that cash gifts, even if it's 100 rupees, 1,000 rupees, 5,000 rupees, it goes into this basket. Jo uska hai, uska basket mein hi jayega. It won't come into my bank account. And everything goes into this basket itself. So when his birthday is there, if he gets 3,000, 4,000 rupees, sometimes in Yugadi, he will get 1,200, 2,000 rupees they will give in his name. All that goes into this basket. I don't take it over there, right? So the market value of this is still around 16 lakhs. As I said, it has not grown much because the market has gone up and down a lot. It is still flat, but it has given me the ability to buy units at very cheap rate. And I'll show you what I have taken as well, right? So the investment style here is 100% equity. There is no non-equity. There is no hybrid. There is no gold. It is 100% equity, or I think there is gold, I'm not sure, but this is a 100% equity based basket because it is 28 years timeline, so I'm not too worried about it, right? And the SIP that I do here is 50,000 rupees every month, but I will be stepping it up as well, and I will show you that. Total number of funds as of now is only 6 funds in this entire basket. Okay, so what is the goal here? Goal is to build a corpus for my son at the age of 30, which is 2054. Investment horizon is 28 years of compounding. 50,000 is my current monthly SIP. And every year what I do is I increase it by 5%. Now, obviously people say that your annual step up should be 10%. I'll tell you realistically, it is a little hard to do 10% because kya hota hai na, 10% also compounds. If it's 50,000 this year, next year it's 55,000, next year it's 60,000, then 70, then 80. So I keep it at 5%. But I also do investments. Whenever I see a big market dip, I add into some 20, 30,000 extra. I will add into this basket as well. I'm taking an inflation of 6%, okay, because I need to be realistic about my goals. And I want to see realistic because it's my own son. So I can't have hawa mein calculations. So I'm assuming that 6% is going to be the average inflation rate rate on an average basis for the next 28 years, because this is what I've taken last data. Hopefully it is lower than this in the future. If it is lower, it becomes a bonus for my son. If it is higher, it becomes more negative for my son. But I can't do much. I still have to plan according to what my plan is, right? Now I'm taking 3 scenarios and I'll show you the baskets, and I'll tell you what is the actual scenario. I've taken 3 scenarios. One is a conservative scenario of 12%, then a base case scenario of 14%, and a best case scenario of 17%. Okay, now please understand one more thing. A lot of you guys who look at mutual funds today, you will see the returns are amazing. But that is also because of post 2020, the liquidity that came into the market made all the mutual funds look amazing. If you remove 2020 and actually go and check the CAGRs from 2000, let's say even 2000 to 2020, that 20-year timeline, or even 2010 to 2020, the CAGRs are not this great. Today, you will see small cap funds showing CAGR of 20%, but in the past, small cap funds were only showing 16-17%. In fact, when I did my study, I found out that mid cap funds over a period of 10 years have outperformed small cap funds and large cap funds. So mid cap is actually, in the last 10 years, mid cap has been the winner. Doesn't mean in the next 10 years they will be the winner. It depends on how the entire value chain of companies are moving. But again, I can't overthink that scenario. So I want to take like a best, best food, that if you create food, you need every ingredient. So I've created a best ingredient kind of a system. So it is not too aggressive. It is not too safe. I'll show you the fund style. So what I've done here is I have taken flexi cap fund. That means it is investing across the board. And the flexi cap funds manager, it's his headache to find out what is doing well and all of that. I've also invested in a contra fund. That means contra funds, surprisingly, if you actually see the data, contra funds have done very well. So contra fund is when the market is absolutely down. Like let's say today IT is a contra. So contra fund will go buy all the IT companies at absolute dirt cheap rate. And if it's long term, eventually it will make up, right? All contra will eventually make up. So I buy contra fund. I've bought a contra fund, a little bit of index fund, a small cap fund, and a mid cap fund. So here, basically, I am very well placed across the next 20 years, that whatever happens, or next 28 years, whatever happens, this basket should build wealth. How much wealth? Not in my control. I don't know. I have no control over that. What is in my control? The SIP I do every month, and the amount of SIP I do, how much can I increase it? And when the market falls, can I do jhatpat one-time investment as well? That is only in my control. Looking at the future is not in my control. But I will show you everything as well, okay? So this is the Corpus projections at the age of 30. Not necessary it will happen, but let's do a projection. And I've taken all scenarios. Let's say 12% hua, 14% hua, and 17% hua. Now, yes, there are some theory that people say that 12% bhi nahi aa sakte, maybe 10% aega. So theek hai na, isse kam aega. Even if it's 10%, it's not in my control, but let's aim for 12% base case. 12% which is conservative, 14 is base case. Why 14? Because I have mid cap, small cap, and contra. That gives me the alpha. Okay, and look at the portfolio, how it will look like. So if I do a 5% step up, it goes like this: 55, 60, 70 over the age of 8 years. Mein 70,000 SIP hoga. By the time it's 25, it will be 1,61,000, and then at the age of 28, the SIP would be at 1,86,000. But at this age, I will stop doing SIP because now it's time to stop that basket. Okay, from my perspective. The total amount I would have put in by that time is 3.67 crores, which is not a very big amount given the fact that it's 20 years with inflation in the future. And if you look at it from a conservative standpoint, that basket should become 24 crores. If I look at a base case scenario, should be 37 crores. And if I look at an absolute best case scenario, it should be 71 crores at that point. This is what I am looking at from a long-term horizon kind of a picture, right? Again, if you want to see a better way of doing things, you can also check some calculators like this. I'll show you. So let's say my monthly investment amount is 50,000. Growth in investment amount is 5% step up. Investment is 12% returns, and let's say 28 years, it will show you a return of approximately 15 crores at that point, right? Obviously, I think it's not taking into consideration my existing amount that I've already invested, which is another 16 lakhs, but chalo 15 crores tak aa raha hai. If you do it in this perspective, okay? If now see the difference, if I increase the step up by 10%, then obviously this becomes 23 crores, but I don't want to take that unrealistic scenario. I'll keep it at 5. If I take 14% returns, it will become 22 crores. And if I take 17%, which I don't think I will get, will be 39 crores. Now, the number might seem a very big number to you, but let me break some myths on this number as well. If you come here, where is the wealth multiple happening? So in the best case scenario, the wealth multiple is 20x. In 20x in 28 years is okay. It is not great because of compounding. And the worst case scenario is 6.8x in real terms, okay, in compounding. Now here you can see that there is something called corpus nominal and corpus real. Okay, why have I put Corpus nominal and Corpus real? If you look at the nominal Corpus, then the compounding is almost 9x. Okay, if you look at this, I've invested 3 crores, it's become 24 crores, almost 8x over here, almost 12x over here, and almost 20x over here, right? But if you look at the real terms, that gives a different picture, and this is what I'm trying to explain to you. It's a little scary also. Now, if you look at this, how does the market look in the future? Okay, if you take 6% inflation at the base case of 37 crores in the future at 2054, in the metro city, a flat would be somewhere around a base flat, a very basic flat would be somewhere around 10 crores. Today, only a base flat is 1.5 crores. In the next 20 years, assuming real estate compounds 2 times, 3 times. So 1 crore becomes 2 crores, 2 crores becomes 4, 4 becomes 8, 8 becomes around 15, 16. So I'm assuming that by the next 20, 25, 30 years, decent 1 BHK house would be 5 crores to 10 crores ka range pe. Higher education at that time would be 3, 4 crores at that time. Today only the best college would be 1 crore. A medium college would be 15, 20 lakhs, but by then it would be 2, 3 crores. Okay, so this is how it would be. If you want to start a business today, 1 crore is required. That time 5 crores would be required. Okay, so this is basically becomes the math for it. If I do an SWP at 8%, 24, 25 lakhs per month he will get every single month. But again, nothing great because the 25 lakhs would be very less in inflation adjusted terms. Now, this is how the monthly SIP looks like. I'll leave that. Now comes the inflation erosion. Now this is the biggest problem. At 6% inflation over 28 years, 1 rupee today equals 4.74 rupees in 2054. Basically, 1 rupee has become almost 5 times with inflation, right? 1 becomes 2, 2 becomes 4, and then it's become 2. So around at 6%, inflation will grow at 6% means the compounding happens maybe every 8 to 9 years. So no problem there. But this is basically how it looks like right now. So if I make a corpus of 71 crores, on paper it looks great, right? But on real today's value, it would be 14 crores. So today, if my son had 14 crores, the way I have to think, today if my son had 14 crores, would he be happy? Answer is yes. So then this is okay, because in 14 crores, I think it's more than enough today. And if he's just 30, then I'll just tell him, don't sell this basket, Baba, because inflation is at 6, you are growing at, let's say, 12%, or maybe even 14%, let's say even at 7 crores. If he has, then I will say just keep compounding it, because this will also keep growing. In mutual fund terms, around 10 to 12 years, your 12 to 15 years, your money becomes 10x. Okay, so if he keeps it for his retirement, maybe it will be much better. And I tell him, you don't need to remove this money only because you can do loan against mutual funds if you really need money. Never touch the mutual fund basket. I have not touched it for 30 years. You compound it and take it to another 30 years. Think about this as a real estate asset. Don't think about it as a equity asset. Easier said than done, even for me, even for him. It's a discipline that's required. Easier said than done, because haath mein paisa dikhta hai to khujli aata hai. But that is the logic behind it. But yes, inflation erosion is almost 80%, and the real value is only around 13 crores or 7 crores. 80% of your money gets eroded by inflation. And I think many of you, I think who are watching this video might be a little bit scared, but many of you watching this video would have also seen that impact happening. If you are in any tier 1 city, right now buying even a 2 BHK house seems unaffordable, even for an average middle class person. That is because after COVID, the money that got printed in the market did not reach the lower middle class or even the middle class. So it is actually very difficult to buy a house. Even I have not bought my own house as of date. I'm only doing investments, right? Because I know if I have to buy my own house and then do interiors of that house and then pay XYZ bribes for that house, 5-6 crores will go. And it's unbelievable because I have to make 5-6 crores after paying 35%, 40% tax, because I'm in the highest tax bracket. Just last year, I paid around 85-90 lakhs in tax. So it hurts, right? It hurts. Absolutely, yes, it hurts. But this is a reality that I'm living in right now in India. So I have to move on with this, right? Now coming to what are the portfolio composition I have done. Please look at this very carefully. And by the way, guys, this is something I have done. Okay, I am only a research analyst. I'm not a RIA. I'm not an investment advisor yet. So whoever is looking at this, please talk to your investment advisor before doing any decisions, because this is something I have done according to my risk profile and my son's risk profile. Your risk profile, your EMIs will be very different from me. So you do your own math. So Flexi Cap, I have put 20% weightage. I have taken the BlackRock Flexi Cap fund for 2 reasons. Now again, here a lot of people, I have done the research. Parag Parek and HDFC is the best performing fund with history over a long period of time. HDFC is a little more aggressive fund. PPFAS is a little more conservative fund. Geo BlackRock is absolutely a new fund. Okay, and it is unproven, but I believe that give them time, maybe they will do better. I cannot predict who will be the number 1, number 2, number 3 fund. But if you look at the math of all the 3 funds, they will all be between 1-1.5% of each other. Let's say Parag Parek will be at 20% CAGR, let's say, I'm giving example, HDFC will be at 19, this guy might be at 18. The only reason why I like Geo BlackRock is, again, not a promotion because you can do whatever you want. The expense ratio is very good and exit load is also not there. So tomorrow if I feel I need to switch, I don't have to pay money and the expense ratio is very less. So that is what I'm okay with, right? Then I've taken a Kotak Contra fund. It is actually one of the best value style funds for long-term horizons, 20% allocation there. I've taken a momentum fund because when the bull market happens, this gives very good alpha. So I've taken an ICICI Nifty 200 Momentum 30 index fund. Again, as you can see, it is a low cost index fund. It is not an active fund. It is a passive fund. So expense ratio is low. Even here, the expense ratio is low. Here, the expense ratio is okay. Then I've taken two small cap funds. One is HDFC and one is Trust MF. I've just recently started doing Trust MF. Trust MF is basically run by Utpal Sheth's group. Which is basically the guy who runs Rare Enterprises or runs Rakesh Jhunjhunwala Fund. So I don't know how they will perform. They have large cap, mid cap, flexi cap, everything. So I said he's a wizard in small cap and they have this thing called terminal value investing. So I said, let me give that a shot. So thoda amount dala hai udhar. Rest I put in the big guy called HDFC. So my problem here is I cannot take bets in small mutual funds. I need to take bets in big mutual funds only because 30 years they have to last and they have to get the best fund manager. They have to operate at the best level. So I can't take any chotu motu fund manager or AMC today. And mid cap, I've just taken one HDFC mid cap. From what I've done research, this mid cap is actually good. Again, I can only take the big guys. I have to take Axis, Kotak, someone that lasts for 20-28 years. If I take some new Rahul AMC, it might not last, right? So that is why. So this is how I've allocated this entire allocation as of now. So very interesting. And these are the amounts I've put in. As you can see, Trust, I've just started doing the small lump sum investments right now. Rest I've put very equated, 3 lakh 20, 3 lakh 20, 3 lakh 20. Index, Contra, Flexi caps, 2 small caps and 1 mid cap. This I know that even if I leave it for 28 years, should get better returns than 12%, only because momentum index will give me better returns, Contra will give me better returns, small cap and obviously will give me better returns, mid cap will beat the index and flexi cap will be at par with the index. So overall, I feel that this is a basket that will get me more than 12%. How much more? Bhagwan ke naam pe, I don't know. But this is what I'm saying. Now, what are the problems that I have to monitor for my son for the next 28 years? One is, look, this is going to have volatility. I know it. But I've never got scared with this basket. Why? Because it is a long-term basket. When it falls 40% also, I don't get scared. Because meko pata hai ye bas, I can't go anywhere. I have to keep invested. I will buy more units. The goal is to buy as many units as possible. So I will buy more units to compound. My only biggest worry is that if inflation goes greater than 6%. Now, some people will ask, Shashank, why not buy gold in that basket? Now, if you look at the history of gold and stocks, eventually, in a long-term perspective, gold and stocks give same CAGR. Actually, stocks give better, gold gives less. But now, if you see, gold and stocks have given same. So I'm saying let's bet on stocks only, not on gold. What I would have liked to do here, I would have loved to get some international exposure, maybe buy a ETF of NASDAQ or maybe buy an ETF of S&P 500 that gives me much better alpha, but I cannot do that. So I'm just going to stick to India right now because a lot of problems. What is the other problem here? SIP interruption. Now, this is my risk. I should not stop the SIP, whatever happens. Every month, 50K. So last year when I did this basket, it was at 10 lakhs. Then now it is at 16 lakhs. Basically, I've increased that basket by 60% this year. So now it is at 16 lakhs. Hopefully by next year, May 1st, 2027, if I just keep my SIPs on, which is 50K a month, it should be at 22 lakhs. But my goal is to hit 24 or 25 lakhs in my son's basket. So by year 3, if it's at 25 lakhs, I know worst case also I'm safe. Okay, even if I stop my SIPs, I know I'm safe, but I should not. Fund manager risk applies to Contra, Kotak and HDFC because the other ones are pretty much indexed only. And LTCG gains are also there, but I am not going to remove. The problem is what happens after 20 years. Let's say 28 years, we have reached 2054 and I'm giving this to my son. And let's say the corpus is, let's say 30 crores or 35 crores. Obviously not inflation adjusted, but that is the game. Now, two options are there. One is he doesn't listen to my financial learnings and he starts doing SWP, ruins the compounding and lives off that money. And this is assuming he has no other active income and he'll use this money to get safeguarded. Fine. The second option is what I would recommend and tell him is, boss, just if you need money, do loan against mutual funds, take 10-15% of this entire amount as loans against mutual funds and use it for whatever you want because the corpus is big. Only problem is he's not going to get dividends out of this. Dividends are factored into this mutual fund as growth mechanisms, right? So he'll still have to do an active job. And if he needs money in short term, do loan against mutual funds and take it. Don't let this mutual fund go for waste. Let it compound because If I have left it for 28 years and it has compounded, when he starts compounding at that point, the compounding math will become very insane, right? And I can show you that math as well, if you want, because after 10 years is what I have seen compounding math go bonkers, right? So after 10 years is when the real compounding starts kicking in. So let's say I do a monthly, let's say we have frequency of investment monthly. At that point, the SIP was 1 lakh, let's say 68,000 a month. And let's say the expected return is 14% on my base case. And this is my son doing it, not me. And this is 2054 and he's 30. Assume he has to do it for another 30 years, which is still 2000 whatever. Oh, sorry, I didn't put the corpus amount only. Okay, fine, my bad. I'll try to find a lump sum calculator. Okay, let's try lump sum calculator. Let's assume he doesn't do anything and I've given him a corpus of 35 crores. Okay, 3 crores, 35 crores at a 14% base rate, and he compounds it for 30 years. That would go up to around 1748 crores. Again, don't get too excited. 1748 crores, inflation adjusted. If I remove the inflation here, it will be 8% instead of 14%, 6% if I remove. It will be 370 crores adjusted to inflation, which is great because that is how compounding starts. My job was to compound until one point. His job is to compound another big amount into that as well. So that is what he's doing. This is assuming he puts 0 rupees into this mutual fund. 0 SIP. If he does SIP, obviously it will balloon to another level. But this is assuming 0. And this is assuming he doesn't take it and does F&O, doesn't take it and try to act funny. He can stick to his job and do whatever he wants. So that is basically the goal of this. But again, I hope you guys enjoyed this video and I hope you guys like this video. If you have any doubts, any questions, put in the comment section below. If you are doing mutual funds and you're not doing a good job, you can go check out the small case that we have. There's a 20% off going there. It is a long-term game. It is not a short-term game. 5 years minimum, you have to stick with mutual funds. Don't look left or right. Okay? Awesome. This is me, Shashank Godaba, signing off. Take care. See you. Bye-bye.